I want to go through what I consider one of the most undervalued and exciting stocks just because it's so boring and it's such an amazing business. And it's the type of business that Charlie Munger said every investor should look at. It's a business that he calls a cannibal. And that's a business that is just buying and buying back its shares. Now, this business is Murphy's USA. They've got locations all over the place. We're going to go do a deep dive into it and figure out if it's a buy or a hold or a sell and what kind of projections we're looking at and why I like it. It's such a simple business and the potential for returns are huge, and the potential for downside is, I don't think, that much, because it really just depends on people buying more and more gasoline. So all I need to do is ask myself, are people going to continue to buy gasoline? Is it time to buy? Is it time to sell? Is it time to hold? Here at the Rutherford Report, we dig into the data to find out. As always, hit that like button, subscribe, and click that bell notification. Next, click on my channel bio, follow my link to discover the best investment to buy now. How do I know what the best investment to buy now is? I watch where billionaires move their money. And the people who subscribe and get on my newsletter will be the first to find out what I uncover. Don't miss out. Go to rutherfordwealthreport.com. Real quick, before we get into this, I am not a registered financial advisor. Do not listen to a guy like me. Statistics say you will lose all of your money. So what I love about Murphy's USA is it is a completely simple business to understand. All you need to know is, do people buy gasoline, and are they buying more gasoline, and is management doing what they say they're going to do? Now, this is a tremendous business. Just look at this. They're in 27 states. They've got 1,760 locations, and they're just pumping gasoline. It's so simple to understand. And one of the highlights that I don't think most people look at is, look at this. If I look at their filings here, they've got $2.8 billion worth of property, plant, and equipment. That's like half the market cap. So that's half the market cap of gas stations that if they ever needed to get into trouble, they could just sell off. So why do I love this business so much? Well, they have two really important things to think about. They're serving the low-cost consumer, and they have lots of locations around Walmart where the low-end consumer goes, and Murphy's tries to sell as much gasoline as possible while keeping the price as low as possible. And they do it by keeping the price as low as possible so that they can sell lots and lots of snacks, lots of cigarettes. And what do they do with all this money? Well, they only do two things, and this is what I'm talking about of understanding why this is such an amazing, simple business. On slide 10, they explain it to you. And what they do is they take half of their money and they give it back to shareholders, and they take half of the money to maintain and build new stores. So they're maintaining their stores, they're building new stores, and they're buying back shares with the other half of the money. They call it their 50-50 capital allocation strategy. And this is a fantastic model because every year they're putting up new stores. They're making their stores better. They're maintaining them. And the other half of the money they're making out of their free cash flow, they're just buying back shares. And then they're buying back more shares, which Charlie Munger says is something that is extremely important and everyone should look at. These cannibals, he calls it, and these are companies that just devour their own shares. And if we look at a graph of that, here is the share count for Murphy's USA. And why does that matter so much? Because every time they buy back shares, that means you as the shareholder gets richer and richer and richer. So yeah, of course, you could go out and buy a gas station, but instead you could buy a company that's building new gas stations, and every year they're buying back more shares, so you become a bigger and bigger owner. In fact, if we look at this, over the last few years, they bought back, in 2021, 10% of the outstanding shares. In 2022, 8.8% of the outstanding shares. In 2023, 4.5% of the outstanding shares. And year to date, the quarter ending June 30th, they have already bought back 5.5% of the market cap. So this, the shares relative to the market cap, however you want to say it, 5.5%. This is tremendous, and this will lead to tremendous long-term returns. So why do I point this out? Because they have a projection, and I'm going to use this projection to build a model to understand what kind of returns we could get. Now, if you're on the last investor calls, they've downgraded their 2028 target from 1.3 billion earnings, EBITDA, earnings before interest, tax, depreciation, amortization, to 1.2, and the market did not like this. So the stock cratered. And that's why I think it's a tremendous value right now. Let's look at this and model this out, because they think their target by 2028 is 1.2 billion in EBITDA and 17 million shares. This is based on their current buybacks they're already doing, and with a multiple of 10 to 12. So I just made this handy dandy financial model because I can project the returns here. So what I did was I used a sampling of what the market had previously paid for Murphy's and what they've done, and you can't really see it in small print here, but I've modeled out that in 2017 they were paying about 7 times EBITDA. In 2021 they're paying about 6, and in 2021 they're paying about 11. So this just allows me to make a model. Right now they're paying 7. So right here you can see, based on how excited the market is, how many times are they paying for these earnings. If they're paying a 6 multiple, well, the 3.5 year compound annual growth rate will be about 2%. Now if they end up paying 10 times, which is not unrealistic because frankly they were in 2024 they were just paying 11 times. Well, that's an 18% per year return here from this price at $3.92 whenever I'm recording this video. And if management thinks it could get as high as 12, if it did get as high as a 12 multiple, well, that would be a 24% per year return. We're talking about star-studded returns, the type of returns that can dramatically change your life. So I know this is a wide margin, but it really depends on how much the market is going to get excited about Murphy's to really depend on what type of return you can get. But here I'm just modeling out the different scenarios. Anywhere I'm projecting a 2% all the way to a 24% return per year. Now, there are huge risks with this stock. What kind of risks? Well, if we have a recession, people are going to buy less gasoline. And you know what? Then Wall Street is going to hate this stock, and it's going to go lower and lower and lower because it's selling a little bit of gasoline. But guess what? There's a funny little thing about this. If the price is cheaper, well, they'll probably just have more money to buy back more and more shares. So if my time frame is 2, 5, 10 years from now, guess what? I'm going to be a bigger owner, and I'm going to get more and more of a return, at least potentially, if things work out. And that comes down to management not embezzling money, screwing things up, and people buying gasoline. It's pretty simple, and that's why I love this stock, and I think everyone should take a look at it and see if it's right for them. As always, hit that like button, subscribe, and click that bell notification. Next, click on my channel bio, follow my link to discover the best investment to buy now. How do I know what the best investment to buy now is? I watch where billionaires move their money. And the people who subscribe and get on my newsletter will be the first to find out what I uncover. Don't miss out. Go to rutherfordwealthreport.com.